Welcome. I'm Nicole Servey, and I'm joined here today by my colleague Charlie Doherty to discuss our latest economic outlook. So Charlie, we haven't really made any material changes to our forecast. So to kick us off, why don't you talk about some of the recent data that we've seen?
Thanks, Nicole. Yeah, so economic growth looks like it remains in pretty decent shape. Now, we did get a softer than expected real GDP print during the first quarter, but that looks like it was mostly due to a larger than anticipated drag from things like trade and inventories. But if you looked at the core components of GDP growth, consumer spending, business fixed investment, those areas look like they've remained strong. So all of the incoming data that we've seen so far for Q2 also are pointing to another strong quarter of growth in the second quarter. Now, I will say that it does seem like growth is set to moderate in the second half of the year, right? If you looked at consumer spending, for example, a lot of consumers have exhausted that pandemic era savings. Higher debt costs are still something consumers are having to contend with. And consumers are also facing a more subdued pace of income growth. So we are expecting consumer spending to downshift a little bit, all while business investment spending remains constrained by higher interest rates, right? So if you look at the CapEx spending environment, higher financing costs have clearly weighed on that. If you look at the construction sector, non-residential activity looks like it's downshifting. So overall, we're still expecting a sturdy pace of economic growth, even though some moderation does appear on the horizon. So Nicole, what does that slower growth environment mean for the labor market?
So we actually saw in the first quarter that job growth was quite robust. So if you look at, for instance, the 3-month moving average of non-farm payroll growth, it was trending higher in the first 3 months of the year. But more recently, we've gotten a look at April, which is the first month of the second quarter, and we've seen that job growth looks like it's starting to ease. So in April, we saw non-farm payrolls expand at 175,000 jobs, which was the smallest increase since October of last year. And so what that kind of implies is that labor demand looks like it's starting to ease. And if we look at the latest JOLTS report, we've seen that job openings have continued to decline, and the hiring and quits rate are actually, they've descended pretty much down to where they were before the pandemic. And so taking that weaker hiring picture together with some softer labor demand, that kind of suggests that the unemployment rate will continue to rise in the coming months. And so we've actually revised our forecast for the unemployment rate up 0.1 of a percentage point. So we look for the unemployment rate to peak at 4.1% in the final quarter of this year. So the gradual loosening in the labor market, we do expect that, as you said, Charlie, because you're looking for economic activity, the pace of expansion to moderate. But we actually saw in the first quarter, like I said, job growth was robust, and we saw that employment costs were actually growing at a quicker than expected rate. So the employment cost index in the first quarter came in stronger than the consensus expectation, which has kind of raised some uncertainty around the trajectory of wages this year. And so Charlie, as you know, wages and employment costs are a key component of inflation. So given this picture, what are your expectations there?
Yeah, so let's take a step back for a minute. I mean, we've seen a lot of significant progress in terms of inflation over the past 18 months or so. Now, that being said, in the first quarter of this year, you did see a wide array of different inflation indicators move up a little bit. So there's good reason to believe that just represents a sort of bump in the road, and that inflation should continue to track back towards the Fed's 2% goal in the months ahead. So if you look at food prices, they seem benign. Energy costs should begin to moderate alongside lower oil prices. And then if you look at goods and services prices, supply chains look like they're more or less functioning normally. There's still a lot of disinflation in the pipeline from shelter costs. And then if you think, okay, we are bound to see a slower pace of economic growth, a softer labor market, that should further help inflation return to that cooling trend. So with all that in mind, Nicole, what does this projected cooler inflation trend mean for the Federal Reserve?
Like you said, Charlie, there's been a little bit of a discussion in terms of whether or not the first quarter was a flare up or just one of those bumps in the road in the path down to 2% inflation, or if progress towards 2% is actually stalled out. And so there's been kind of a chorus of commentary from Federal Reserve officials signaling what's the rush, which kind of implies to us that the risks to our Fed call are skewed to less cuts rather than more. So we haven't changed our base case. We still look for 50 basis points of easing this year and then followed by 100 basis points of easing next year. And so specifically, we don't look for the first rate cut to occur until September, 25 basis points there and 25 in December. But as I mentioned previously, there's been a little bit of uncertainty around inflation's progress back down to 2%. And so the risks of that forecast are skewed towards less. For instance, if you look at the Federal Reserve's latest dot plot, so they released this in March of 2024, and clearly conditions have changed since then. But that dot plot implied that the Fed was looking to ease 75 basis points this year. So if I were to characterize the risks, I would say certainly not towards 75 basis points, maybe more towards just 25 basis points of easing this year.
Thanks, Nicole. And thank you for joining us today for the Wells Fargo Monthly Economic Outlook.